Buy now, pay later. BNPL companies now collectively carry over $500 billion in debt, according to industry estimates. This figure is difficult to precisely track because BNPL firms are not required to disclose their lending in the same structured way as traditional credit card issuers. This lack of transparency is particularly alarming given the short-term nature of BNPL loans, which are generally designed to be paid off within 8 weeks through predictable installments. However, recent studies and internal disclosures have confirmed a growing issue. Many users are not paying off these debts as intended. Instead, BNPL has become a financial crutch, used not for convenience, but as a necessity to bridge the gap between paychecks. Though most of the largest BNPL companies are barely a decade old, they have scaled rapidly. This growth has been fueled by abundant investor capital, a relaxed approach to regulation, and consumer appeal stemming from the avoidance of traditional credit checks. These companies have marketed themselves not as lenders, but as facilitators, helping users split payments into smaller, interest-free installments. If all went according to plan, users would never pay interest. But after years of lending without strict controls, many of these firms now face the harsh reality that much of this non-loan debt is not being repaid. While rising consumer debt defaults are occurring across all sectors, BNPL carries unique risks. Unlike credit cards, these services often attract younger consumers with limited financial literacy, encouraging impulse buying and unsustainable habits. Social media is filled with testimonials of users using BNPL to buy concert tickets, clothing, and even groceries. The allure lies in the illusion of affordability. Breaking down a purchase into 4 payments makes it feel less significant, even when it isn't affordable in the first place. At first glance, BNPL services and credit cards may seem similar. Both allow for delayed payments, offer interest-free grace periods, and facilitate spending beyond one's means. However, a significant difference lies in profitability and risk. Credit cards are among the most profitable financial products for banks. Despite interest-free periods, banks still earn returns 4 times higher on credit cards than on mortgages or personal loans. In contrast, BNPL firms have struggled to turn a profit. Public filings reveal substantial losses. Affirm, for example, lost nearly $500 million last year, an improvement over the previous year's billion-dollar loss. Other players like Afterpay and Klarna also report steep financial losses, but specific figures are harder to obtain due to private ownership or acquisitions. These companies often tout profitability based on selective accounting, such as using AI to reduce customer service costs or assuming overly optimistic repayment behavior. But once borrowing costs, loan defaults, and operational expenses are considered, actual profits often reveal massive shortfalls. Klarna recently reported a quarterly loss nearing $100 million, doubling its losses from the same period last year. Despite widespread adoption and increasing transaction volumes, the core business model remains unprofitable. BNPL companies rely heavily on charging merchants higher transaction fees than traditional processors like Stripe or PayPal. While typical credit card fees range from 1.5% to 3.5%, BNPL providers have been reported to charge up to 8% per sale. For many retailers, this fee wipes out their entire profit margin. Yet merchant agreements often prohibit passing these fees on to consumers, forcing businesses to either absorb the cost or raise prices across the board. So why do merchants continue offering BNPL options? Because it works. BNPL users tend to be younger, more impulsive, and willing to spend more. A study by Harvard Business Review found that BNPL increased the likelihood of purchase by up to 26%, with average basket sizes increasing by 10%, driving a total discretionary spending increase of 30%. For retailers, that level of spending is too tempting to ignore, even if it strains their margins. For responsible users with access to traditional credit cards remain a better deal. They offer better rewards, more flexible terms, and stronger consumer protections. More importantly, they are subject to tighter regulation. BNPL loans, in contrast, often avoid classification as formal debt. This loophole enables providers to lend to individuals who might not qualify for traditional credit, and it allows consumers to stack debt invisibly, applying for multiple buy now, pay later loans and credit cards simultaneously, without any lender seeing the full picture. This system creates opportunities for financial gymnastics. Consumers can delay payment obligations by months, effectively turning short-term loans into long-term debts. While this might appear clever, it's often a sign of desperation. For many, BNPL isn't about indulgence, it's survival. An industry survey by LendingTree revealed one of the fastest-growing BNPL categories is groceries, and a 2023 Federal Reserve study found that over half of BNPL users adopted the service simply because it was the only way they could afford the purchase. Despite their growing role in consumer finance, BNPL companies are not regulated with the same rigor as banks or credit card providers. This regulatory gap means consumers are exposed to significant risks. These platforms also gather extensive data on user behavior and partner with brands to deliver targeted promotions, blending shopping with financial commitment in a way that further blurs lines between needs and wants. Once valued at over $45 billion, Klarna's investor appeal was built on the hope that it could become the go-to payment option for a new generation. However, instead of building sustainable lending practices, much of the capital was funneled into operational costs, servers, staff, and office perks, while the actual loan capital was borrowed externally. This structure, standard in finance, relies on good lending practices to be viable. Yet Klarna lost $136 million in unrecoverable loans in a single quarter, effectively wiping out any profits generated from interest and fees. Compared to traditional banks, which lend more cautiously and have diversified income streams, BNPL companies are struggling to manage risk effectively. In practice, BNPL has become a high-risk version of payday lending. But unlike payday lenders, who charge exorbitant interest to cover defaults, BNPL providers can't do the same without harming their brand image. Their business depends more than ever on merchant fees, but retailers are beginning to resist. Major partners like Walmart and DoorDash negotiate steep discounts on fees, which may help secure market share, but further erodes profitability. This mirrors patterns seen in other disruptive industries. Just as Uber, Airbnb, and Netflix began by undercutting incumbents before eventually raising prices and cutting services, BNPL is in its growth at all costs phase. Eventually, these services will either become more expensive or more restrictive. For businesses, this could mean steeper merchant fees. For consumers, it likely means more hidden costs and fewer benefits. There are no real winners here. Retailers, consumers, and even the BNPL companies themselves are all under pressure. And when the debt comes due, someone will be left holding the bag. As with many trendy business models, BNPL reflects a deeper sickness in the modern economy: the pursuit of short-term growth over long-term viability, with consumers caught in the middle. Thanks for watching InvestingFlix. If you found this video helpful, don't forget to like, share, and drop a comment below. For more expert insights on personal finance, investing, and wealth building, hit that subscribe button and turn on notifications so you never miss out.